All right, everybody. It is 6:05. We're going to get started, and we're starting off with a pretty cool announcement. We talked a little bit about it last week, but we have been putting in a lot of energy into our hackathon. If you're not sure what a hackathon is, I wasn't either. So watch my funny video saying, "What in the world is a hackathon?" Sanjay's the king of hackathons, and it's something he did in his previous life. But if you can imagine a full day interactive with people looking at deals, underwriting deals, analyzing deals, going all the way through. So in theory, the concept is buying a multifamily in a day. It's going to be held in Houston on April the 5th. Starts at 8 a.m., goes till 7 p.m. It is going to be exciting. So you can scan this. We'll also put a link in the chat for those that don't have the capability to scan, but it is going to be an amazing day. We're only charging $39, which is in theory, like you're going to get $3,900 worth of value out of like this. It's going to be incredible. It's really just us covering the lunch costs. So we're super excited about it. So be sure to join us. All right, let's go to the next slide, get going here. So again, our educational series. We are not professionals, we're not lawyers, we're not financial advisors. Yes, the event is in person only, sorry. We're going to try to hybrid it at some point, but right now it's in person. So we offer what we believe to be true and factual, but always check with your own accountants and lawyers for your own advice. So we're going to talk a little bit about massive capital. We're going to talk about investors and partners. Is the worst behind us, or are there more troubles ahead? That's the topic for tonight. So a little bit about Massive Capital. We're a vertically integrated real estate company. We're an owner-operated for value-add multifamily assets. We specialize in ground-up construction, retail, flex space, industrial, self-storage, and mixed-use multifamily. Combined with Realty One, we have 42 years experience. So on the left, we're involved in equity. Brokerage and property management is on the triple net. For those of you that don't understand triple net, that is really in the commercial retail type space. It is not in the multifamily space. Development, construction, both metal and wood. Our mastermind with our education is taking off like crazy. So don't miss out. There'll be a little bit more information. But we have created 25 general partners in the 2 years that we've been involved. You'll see on the map, we are definitely Texas focused, but we do have assets in Denver, Colorado, North Carolina, and in Georgia. And we are looking for retail development in Phoenix and Tampa, not multifamily at this time. You can see Realty One has $290 million in assets, and Massive Capital now has 200 million in assets. It's pretty exciting. We're this close to that $500 million mark. We're almost there. So Sanjay, you got to get one of those LOIs accepted so we can get there.
Yep.
And this is our team behind the team. So you can see a lot of the folks are on the top row, or I'm going to refer to as the usual suspects that you would talk to, including myself, Jasmine, Maria, Candace, Brenda. And then we have our extended team here that are doing lots of work. And then, of course, we have the Realty One team that's going to be amazing. And we also now have a full finance team and tech team. So we are really getting to the next level. It's super exciting to be part of this journey. So the team, the partners. So we have Shirar, Sanjay, and Mike. They're part of the Massive Capital. And then on the Realty One side, there's Bo, Pat, and Alexis. They're our fearless leaders. They challenge us every day. So a little bit, we did 15 closings on 22-23. We're finalizing a PSA for new construction in Houston. We have LOIs pending in Dallas, San Antonio, and 3 in Houston. We do have our value add deal in San Antonio. So talk a little bit about this. We're actually probably about 87% subscribed at this moment. We're almost full up. So this is the true meaning of value add apartments. We bought this 204 units at an amazing price, under $83,000 a door. There's a lot of opportunity for value add. We are projecting a multiple equity of your money of 2.11, an 18% return. And this particular opportunity has a 7% prep. So we will put connection in there, but if you're interested in getting more information on this opportunity, reach out to someone on the investor relations team. We have one spot left. So this one is filled up really good. We're super happy to have our last few investors. We did have a 1031 exchange fallout. Sometimes those are a lot of work to get in, and it just didn't happen. So that opened up some. So this is a new build retail. I was actually there last Wednesday, did a video. Yes, I misnamed it as a bulldozer when it was a front end loader or something. I don't know much about machines, but I know about investing in real estate. So this one has a 20% internal rate of return. It is a 1.72 estimated multiple. It does come with a prep. And this one has a 70-30 split up to 17 or 50-50. So again, at the 20, we've assumed that we're going to reach the 50-50 split. This is a great opportunity if you're looking for a little quicker turn, having all of your money back with its multiple in 3 years. All right, Mike, it's all yours.
All right, Trevor, thank you very much. Great kickoff. And oh, I meant to launch, if you want to launch the
Yep.
poll on Horizon, maybe to get that started. So as we talk about the way we partnership, and this is where the opportunities come for those that want to get involved. And everybody, we have a more or less a different way for everyone that has an interest in partnering, whether that be through passive investing with us as limited partners, or if it is actually, coming in. And in the case here, we have landowners. If you own some really, some cool land that's in a good location that, makes sense between you and us, that we say, okay, let's go take that piece of land and develop it, then we can do that together. And we bring you all in together as part of the team. We do the whole process from the development to construction, the debt, capital raising, through the execution of the project. We also have assets under construction where we looked at some projects that were in Austin recently that were already under construction. They stopped. They may have struggled a little bit with funding or other things. And we're set up to take over that type of project if you want to do it yourself and have us come on, as partner on it, or we joint venture in it and do it. So we have that as an opportunity. And then we also do on the multifamily side, we have a tool, and I think we'll talk about it here and talk about it in the last piece, but we have a doing asset management and a proprietary tool that we built through basically through seeing the process of the deals that were done and what we needed. And we didn't want to be waiting on the property managers to give us data. So we created a tool where the data comes into the tool. We know what's going on with the property ahead of time. We have a full dashboard of key KPIs to look at and give feedback to the property management company ahead of time. We also do CapEx on different deals. And the last part there is credit enhancement, which may sound a little funny. We're not improving anybody's credit. We just are able to do deals with you. We can bring the balance sheet, liquidity, and a key piece is experience. So some people that you may have liquidity, you may have the balance sheet, but if you don't have the experience, some of the lenders still will not necessarily want to do a loan. So that's a key piece. And then our capital our CRM, which is an all-inclusive. It's a website plus CRM and automations all built in. You'll be seeing it coming further out Client Harbor is the new product that we're delivering for that. You can still go to this website and get connected in there and get access to that CRM and those tools that come with that. And I already talked about the asset management. We're looking at it also as a consulting for larger operators or funds that have multiple products under assets under management that they want to look at some portfolio management options. So those are the key ways that we all can partner together. And go ahead to talking now about what is coming forward. Is the worst behind us, or is there more to come? So I'm going to turn it over to Sanjay, but first I'm going to just talk about what happened last week. We talked about it here a bit, the Fed plans from last week. There was no rate cut, and the economy is staying strong, and the potential is another 3 cuts in the rate by the end of this year. And what size those will be, still up in the air, and then 2 more rate cuts next year. So what does that mean to us? And I'm going to let Sanjay, we're going to run through some scenarios of the economy stays good, no interest rates. What does that mean? No interest rate cuts. What does that mean? The economy flattens, or the economy stays subdued and inflation in control. So, Sanjay, you want to kick in here a little bit and get us rolling on this topic now?
Yeah. So, as most of in the last couple of weeks, what we have discussed, the Fed structure and how they take the data in and they make their decision. And even though we see Fed as deciding interest rate, right? But from my business school, and a lot of the thinking is, well, Fed has no choice on the interest rate, and interest rate really follows the economy, inflation, the economy growth, and all those things. And overall, the disparity in economy is there. A lot of us feel differently, depending on the areas we live in, or so a lot of those factors. So disparity is there, but at an aggregate level is where Fed decides, right? And as a country as a whole. So if the economy stays good, good meaning 4%, 5% growth, GDP growth, inflation, absolutely no interest rate change there, or potentially even an increase. So last week we reviewed the CME website, where you can go see the projections and probabilities, and all of those are that no rate cut for the next 3 to 4 months at least. Economy flattens, inflation in 2% range, which is the 2% is the target for Fed. Rate cuts implemented as planned, so the 3 rate cuts potentially implemented, and economy stays subdued and inflation in control, then another 2 rate cuts next year. That's kind of the guidance. And again, Fed is following that inflation, right? So the inflation gets to that 2% range, and inflation slash GDP, right? And inflation, there is a lot of things that go into inflation that can skew the inflation itself, but the GDP, how the income of United States as a country, that's the gross domestic production, is a solid number, right? There is less discrepancy on that. So GDP grows by 2%, 4%, 5%, absolutely. Inflation is going to be high, and interest rates is going to follow that GDP growth. So that's how we can look. So yeah, that's kind of the background on this. You want to talk about this, Mike? Back to you.
Yeah, no, just really wanted to talk back and forth with you about this a little bit, Sanjay, and tried to redact some information. But just wanted to share a message a little bit about, what's happened or what goes on, right? So sometimes, the question is, a deal or, a group of deals goes into forfeiture or is having to go back to the lender. And what are some of the reasons behind that, right? And in this case, it talked to, entered receivership after running out of cash, right? So, one of the key things that we talk about a lot, and before we do a deal even, is, both what is sometimes the reserves and the strength of the team that we, in previous times, we were partnering with some teams, and we wanted to know, what was the overall strength of the team, or if we were going to KP on some deals, what is that overall strength, both from a experience, but also from a balance sheet and liquidity. And I wanted, to chat with you a bit about, why that is important, and, what are some of the things you've seen from that overall experience from your period.
Yeah. So, just like your household, right? Any of these deals that go south, invariably the deals go south because they run out of cash, right? And our interest rates and everything else that we were talking about before, you have your basic expenses, in our case on multifamily running the project. You have your taxes and insurance, your regular things. You don't have much control. You got to pay, or you're in other troubles. Beyond that, the all the other expenses are controllable. You can control, you can cut, you can reduce, go that way. And once those are done, you have the cover the debt, right? And it's when you don't not able to cover the debt, invariably that's where it goes into, you get into trouble. So the debt and the interest rate conversation that we just had before this kind of feed into that, right? Like if you have enough cash to cover your debt scenarios, or if your debt really has no variability and you have enough cash to cover a certain period of time, you can be safe. You don't have trouble. You don't have issues, and you can continue to operate. Really, operations usually is not a significant portion. 50 to 60% in Texas. Some of the other states, the operational expenses are only like 30% of the income. So you have a lot of cash left there, and that is your biggest variable there with the interest rate that leads to trouble and goes there. So with all that in mind, how do we tell, how do we say, is it over or is there more trouble, and where we are headed? So yield curve.
So I would say,
Yeah.
before you jump forward on that, I was going to see, but I think Shariah had some thoughts as well. He wanted to maybe share
Oh, yeah. Go ahead, Shariah.
things we've seen there.
Hey, Mike, thank you. So it's one of the interesting reflections that we had. So we underwrote last year, we underwrote a little over 600, almost 700 assets. This year, in this 4 months, we did a little over 200 already. And what happens is, depending on the location and the buying price going into a deal, when that cash gets hit with non-controllable, and we cannot improve the revenue because the business plan was taking longer than what we have forecasted, it comes down really, really quick. And almost virtually all the deals that we look at right now, it has some kind of a distress to it. Like last Friday, Saturday, I walked 5 properties in Houston, all 5 of them going to foreclosure next on the 1st. Now, with that note, keep in mind, a dominant chunk of the deals goes back in bigger deals itself wasn't good enough. And maybe there's some of the weak operators, but sometimes you got strong operators. They have done everything right, but market turned much faster than what you could think of, right? So just thinking it through as you kind of go through more of the unit, slower it is. Smaller the unit, faster it is. 150 units or less, we can turn that thing around in about a year and a half probably. And if it touches more than 350 units or so, it takes solid 3 to 4 years. And if you have a business plan, it takes 3 to 4 years to turn, and the tornado showed up in year one, then it's tough. And that's the way to kind of take a look at it, right? Back to you, Sanjay.
Sounds good. Yeah, exactly right. Sounds good. Thank you. Um, so yeah, so the all these interest rates are based on these yield curves, and everybody talks a lot about those. So what are these yield curves, and how do these work, right? And then we kind of look into that a little bit, and then try to see we can figure out if is it over or not. So these yield curves is the return on your money, the interest on your whatever the money you put in the safest place, the bonds, the savings accounts, right? So it really reflects the collective sentiment of the market, and it shows how is everyone feeling right now, right? Even though it's how is everybody is feeling right now, but it shows how is everybody feeling about what's going to happen 1 month from now, what's going to happen 2 years from now, and what's going to happen 10 or 20 years from now. How is everybody feeling right now, right? So if everybody's feeling fairly good about the 10 years from now interest rate, they say, well, yeah, no matter what, I can pay this interest and I can make more. So that's the kind of flows through and goes this. So what is a normal yield curve? So you see this color, the orangish color, is the normal yield curve, which is the short-term money is always less yields or have lower interest, and the long-term money have higher interest, because the longer you leave the money or have a commitment for the capital to wherever you leave it, whoever is using the capital, they can do things with it and they can get the return, right? So that's a normal curve that is typically there. And then you can see a steeper curve than the normal, and then the flat and the inverted curve. So you see about the inverted yield curve a lot. So flat is that generally the market is feeling and saying, well, whatever the market conditions are today, I don't expect it to change. And I expect to continue 7, 10, 20 years the same, right? And it tells us information. Hey, wherever we are today, that's what it's going to look like. Inverted yield curve is, market is saying, well, whatever return I'm getting now, in future, I'm going to get lower, right? Or the other way to say that is, well, whatever I'm going to get in future, 10, 7, 10 years, right now I'm going to get higher, right? And again, this is a proxy for the growth, right? GDP and the inflation, right? So that's the key, is that interest rates follow the growth, right? So the higher the growth. So in a long term, over a 10-year period, it stabilizes and it's at a certain averages, right? So can it really predict the future? Well, let's take a look at it. So these three are the yield curves. This gray one is the yield curve, what it looked like in March 2022. Let's do a little fun poll here. What type of yield curve is this, based on the previous graph that we were looking at? Feel free to put it in the chat. I'll take the couple answers. What type of yield curve is this gray one, and the gray one is from March 2022. So everybody's saying flat, but looking at the scale is 0 to 2.5%. It's really your normal yield curve. So if you look at this, normal it's lower today and higher in future. So it's 0 to 2.5%. And scale is a little different on these two graphs, so it tricks your eyes a little bit, but it's looked like a normal yield curve in March 2022. And then, what does the yield curve look like? How did it change in 1 year, right? So this gray one is 2023. So in 2023, it was an inverted yield curve. And so inverted yield curve predicts usually that, hey, you have trouble in the future, meaning, right now the interest rates are higher than what you would have normal on the short term. In future, it will be lower. So your growth, your GDP, your economy is going to have to contract and have to go down. So 22 was predicting that, oh, it's all normal, it's great. 23 was predicting that, oh, we have trouble ahead and it's going to continue that way. Well, how did it change in 1 more year? So the current yield curve in March 2024, it is very similar to 23, and it is going there, right? So this website, U.S. Treasury yield curve, shows the yield curve for any given date that you can put there. So how do I get rid of these? So this shows as of today, it's an inverted yield curve. Today, it's higher, and in future, in 7, 10, 20, 30 years, it's lower. You can pin that, and then I can say, hey, what did it look like a year ago? So that's my 2023, March 2023, still an inverted yield curve, but it was going there. And we just saw that the 2022 yield curve, right there it looked like your normal high in the future, and it goes up, right? What did my 21 yield curve look like? And my 21 was very similar to 22. Oh, I did not pin the 22 yield curve. So there is my 22, there is my 21. And then, I say, well, okay, let me go see what it looked like 10 years ago in 2014, and look at that. So the 2014 is right here, which looked like a normal yield curve, which really means that 10 years ago in 2014, 2024, the yield curves are predicting to be around this 3.5%. But our current yield curve is this one, which is this blue, and we are all the way up here, right? So how was the market feeling about 2024 back in 2014? Are we off? We are quite a bit off, right? And then if I go to 2004, what does that look like? There's my 2004 curve. And again, if I compare it to 2014, it actually matches very closely, right? And if I look at it at 2024, we are quite a bit off, right? So within the last 20 years on the yield curve, you can play with this website here yourself and kind of look at it. But just within the last 20 years, it's quite a bit of a variation of how correct the yield curves were, right? So can the yield curve predict future? Is always the question. Before I go there, Sharad, I know you watch this and follow these things quite closely. You have any comments or anything to add here?
Yeah, I can add some comment to it. So I'll take you guys in 2019. So I used to work at Shell, and so given the role, I used to look at the global data. We remember talking about it, looking at the European market, Asian market, and also the Latin American market. It's 2019, the US was in a statistical recession. That meant we're just kicking the can down the road. Anytime it was gonna go belly up. So we all are getting ready for it. So I was in real estate. I was like, I'm not gonna buy anything apartments, right? And then boom, COVID, and the whole COVID came about. And market we just pumped the money, it did what it did, right? So so for us, we're a little bit more academic. We don't know how the market's going to play out in future, but at least we know where we are today, right? So based on that 2019, we had a position, and we were wrong because of a global macro, risk that kind of popped in the COVID, right? Going into the COVID, and for us from the massive side, we said, hey, we do know what money does at the end, but we don't know when that's gonna come into the play. So we end up buying a lot of different kind of assets. Then coming out the COVID time, we kind of sort of knew that interest rates going to go up, but we didn't know how fast it's going to go up. We don't know when it's going to go up. We forecasted whatever that we have forecasted, right? The whole point is we may believe we know everything, but we don't know everything, right? We don't know anything, So the forecast that we do is based on the snapshot today. That based on all the available information today, I believe next 5 years, almost next 1,500 days, is going to play out exactly the way Excel says, but that doesn't happen in reality. That's why we run a lot of sensitivity and trying to bake into the, breathing room into the project. When thing happens, we're going to be down, but we should be okay. So the whole point is from this slide that every forecast is based on all the information today, and a good chunk of assumptions is going to be different and about 60 days out, 90 days out. So have some flexibility within your design of the project that you have, right? Otherwise, it's just tough. And like now, rate cut, remember that, coming into this year, every single thing Fed's going to cut it. Yes, Fed's going to cut it, but they don't want to cut it. At least up until today, we never had a time when Fed cut rate, dramatically, right? So one time we had it, right? When the interest rate went down to 0, Fed cut it 0.5 point, 1 point, they kind of really cut it. But this time, we don't think so. The rate cut will be as steep as last time. So it's going to be slow and steady. So the 5 handle is here to stay for a long amount of time. So how long, we don't know, but at least we know 2025-ish. Probably it's going to be to the 5 handle or so. So it's going to be a slow step down process. So from this point, it's higher for longer. How high? A directional version of that. How long? It doesn't really matter because whatever asset that we buy, we're going to hold that asset for at least 3 years. So we should be out of that high period after the 3 years. So in other words, just keep in mind, whenever we work, we get paid for our performance. I hope the economists would get paid the same way, but they don't, right? Back to you, Sanjay.
Yeah, thank you. Good perspective. And key point to observe here, kind of what Shrai said. Short term varies, but long term converges to certain range here. So as we talk about and get into, can we really predict the future, right? So, these yield curves are accurate reflection of current sentiment. So currently, how the market is, based on all the information aggregated, yes, it is a true reflection, right? All the lending and credit is based on these yield curves in some shape or form, right? So whatever the pricing for any credit or any loan or capital happening, it's based off of these. So, remember earlier we talking about the cash and running out of cash. Whatever we're doing right now are affected by these yield curves because that the big chunk of the cash from your project is going towards the debt to cover the debt, right? So these are affecting all our projects, right? Yield curves can influence the outcome or pace of outcomes. And I put this word pace in quotes here because one of the biggest things Fed has tried to do is, you hear the word soft landing, where yes, the growth was too much, the GDP was growing too fast, too much, need to reduce it. You do reduce that too fast, too much, that's a bigger problem, and then you go the other way. So yield curves, impacting the pace of that outcome to slow down or speed it up, the GDP, the growth of the economy. Yield curve is one of the tools used. I'm saying yield curve, but that inflation is the tool to reflect that outcome, right? But at the end of the day, it's the economy and human activity is what determines the future, right? And human activity I put there because whatever we do, if we know something, we would plan for it, and we would either if it was going to be a disaster or going to be something that's going to cause a recession, and if we know about it, as human beings, we'll take actions and not let that happen, right? As a collective society. But if something was going to be really, really good and was going to have a good outcome, as a human being, we will all rush to it and reduce the return of it by investing capital or doing more of that. So it kind of balances and averages out, right? So it's always the unknown and the unpredictable things that cause the recessions or downturn, and that we react to, and economy gets impacted, right? But it's really the yield curves and interest rates are all follow the economy and the human activity, right? So it's really those are the things that predict the future and determine the future. And who can predict human activity, right? Nobody knows what somebody's going to do tomorrow or 1 month, 6 months from now. So my personal opinion and is, yield curve is good for some influence, some short-term decisions, but on the long term they do converge. So we can be sure that while multifamily is a great investment, in our opinion, again, over a long period of time, but if you want to flip over 6, 12 months, 24 months, absolutely not. And it's hard to predict the shorter term, and that's where a lot of people got burned. And on this side, massive capital, my opinion, our opinion is that AI has a tremendous impact on the productivity of the human race. It's at a level that unforeseen before, right? So that's a huge growth factor. The productivity is increasing. And then there are the other factors of the various wars or conflicts between various areas in the world, and globalization going to localization. All different factors are playing that are leading to maybe reduce the economic activity, but AI is leading to an increase in that. So there is a push and pull, and where that will land is really, we just kind of have to wait and watch. But we know over the long term, just like these are very stable, 5 to 10 years out, very stable. They kind of converge to certain levels. So yeah, I mean, we can get some guidance from yield curves, but really, I don't think we can predict looking at the yield curves that, oh yeah, recession is going to end next year, or we're going to have lower interest rates. But as a sentiment, we definitely have good indications from these activities. So back to the question: is the worst over, or is it continuing? Right. So given the latest data, the inflation, the GDP growth, the economy, the wages, the job market, and the overall numbers that are the jobs being created, we think for this year there is another 5 to 6 months of continue to have a higher interest rate. And we are still holding the position that maybe 2 interest rate cuts this year, even though Fed said 3 in their meeting last week. So we think AI have a bigger impact that will continue to improve and help with the growth of the economy, leading to that one less cut. And then leading into the next year, following the presidential year tends to have a more slower economy than faster, just on a historical data. So next year would be another 2 rate cuts, and anything else beyond that is yet to be seen based on the human activity.
Sanjay, let me add another layer of color to it, right? So now when we ask the question, is it over? Now we have to, right now, based on the position that we have to add a little bit more. Is it over for who, right? Is it over for economy? No, not yet, almost there. Is it over for interest rate? Almost, not quite. Is it over for sellers on the commercial market? Absolutely not. They have another year and a half to go. And is it a good time to buy the assets, right? Because there's always 2 sides of the coin. So if there is a seller who improved the NOI, had enough time coming into this phase, they're going to get a haircut, but they're going to come out okay. I mean, market took in everything based, everything we pay is based on the NOI. Doesn't matter which way we cut it, high interest rate, it takes 10, 15% on top of the price, even at the best performing asset, just because the interest rate changed, right? So for commercial asset sellers, it is yet to pass. You have another year and a half to come. Lenders are trying their best to renegotiate and to redeploy new capital. The new capital wants to get their higher return. That's because the cost of capital is high. So for sellers, it's no way it's over. You have another at least a year to go through. For buyers, this is the time. You gear up, underwrite, and you resize. You're not gonna get the best because it's not gonna be 2008. It's not nothing like that. Market is pretty efficient. They know both sides of the coin, and there's a lot of money has been raised and put outside. So those are transactional, unemotional money. They look at the number, they look at the quantity, return, time, and they'll execute on the dollar. Once you calibrate everything, market is pretty efficient. So it is the time to get back into the game and keep on, because we're not going to have, we believe that next 6 to 8 months, the price calibration will be pretty good. It's a healthy time to buy an asset. The whole in-rush, what Sanjay was talking about, when someone gets in it and your neighbor gets in, then your second neighbor gets in, then even though you come at the tail end of it, you still want to get in. That in-rush we saw, now the market has been calibrated, so we're expecting the price points to be very good, calibrated for next year and a half, 2 years before the whole inrush of the whole thing happens. So going back, is it over for who? Always ask that question. That's the second layer of qualifier you got to ask, and then you answer the question moving forward. Right. Back to you, Sanjay.
That's a good point, Sharad. Thank you. Is it over for who, right? Like everything have two-sided impact, right? There's always whenever you sell a stock, there's a buyer and a seller, right? So is it a good deal for both? Good for one, and different circumstances and different outcomes. So yeah, it's a growth-wise, deals-wise, it's definitely a buyer's market. That's what we're seeing. If you can find the money, find the lending, find the loans, it's a huge buyer's market right now. So, wow, 48. So we have 12 minutes left to 7 o'clock. Let's take some questions.
So we have 2 questions. One was, how could a general partner come into a deal and use some of their profits to become a partner? And then, other than creating an Irish robot, Irish Kevin wants to know how we're going to use AI to improve our systems. So those are our 2 right now, but if any other ones, please put them in the chat.
Yeah, so Mike, you want to take how does GP come into the project?
Yeah, I can start with that one.
And I don't know if we want to stop sharing so we can see everybody. We usually do that on Q&A.
Yeah, that's great.
See all these beautiful faces. Look at them all. Wow. We're all hiding.
And we'll want to go back, I think, because we missed one last slide before we wrap up real quick as well, though, Sanjay, if you can go back to the slides and then I'll do the.
Okay.
Just want to get to the,
yeah. Okay. Yeah, that's right. Sorry about that.
I just want to announce that while we still have a good.
Yeah, that's great.
Group here. So as I get into talking about the general contractor, GC, becoming into the GP, we do have coming up, scan the QR code here. This is free. This is not in person. It's live on Thursday. So Thursday at noon, the Massive Masters Raising Private Capital event is going on. And we'll be having Michael Guthrie joining us with Maria Marks this coming Thursday. And love to have you all come and join us. It is a free event, so you'll get you'll get more value than you can imagine for that. So just scan the QR code there. Let us know if that works. If you got any problem with the QR code, let us know. So there's 2 different ways I wanted to look at and talk about the forming a team, right? So the whole thing about a general contractor coming in is we talked at the very beginning about how we've built out our team, and we've been working on building that team over two plus years now and continue to build on it. So when you're starting up a new, group or a team, and this is something everybody will learn at the hackathon, is like, what are the pieces you need in your team to be successful? It's not just, hey, I go buy a deal and it operates and we're done. You need to have people on the team that can do different parts that not everybody will want to do or can do. And part of that is doing, CapEx work on a value add, for example. And if you are a general contractor and that's a value you can bring to a team, you need to, work with and find the teams, and don't try to just sell like, hey, I'm gonna, do it at cost or do this or that. Come in and start providing value to the team. Go look at the deals, start helping come up with like, what is the CapEx plan? What is the cost? You need to be part of the team from the very beginning, not just, hey, I want to come join your team. I can do this part and I can save this money for you and give you, credit back, and then I can earn some money on the or part of the GP. What you really want to do is become part of the team at the very beginning. And this applies across really all of the aspects. When you're building your team, you need to work together before you really get in to actually do the first deal. Because once you do that deal, then you're really married for 3, 4, 5, 6 years, depending on how the whole operation goes. And you want to know, like, hey, how are we going to work together? And we've actually done some process together for some time. So it is feasible. It is possible. It's a great way. It's a great opportunity, service to add, but add it more than just the end value. Add it from the beginning to the end to in the middle as well. Thank you, Sanjay. Shariar, you guys, anything else, or Trevor?
This was awesome. Maybe we could stop sharing. And I put in the chat, who wants to get married? Massive Capital loves their partners.
Damn, Trevor, only you, man. I gotta give you that. This is the Trevor stuff that dude, we love you, man. You're special. So
yeah. So, but it is real estate's a team sport. Never forget that. And you need to work with people. You need to work with people like and trust. You need to bring value. And again, we put a lot of energy into these webinars. And the reason is we want to bring value to the community. When we sat down and started mapping out a plan, we thought we want to bring a place where people feel comfortable and it's a friendly environment where you can share and learn. So if we missed any questions, let me know. Oh, AI, we didn't talk about AI.
AI
I think
question.
we need
AI,
to make an Irish robot and
Before you answer that, just wanted to share again, I put the link again. Jasmine, thank you for that great link there on about the hackathon in Houston. And we do have some specials in Eventbrite going on. If you guys go there onto that link, you'll get some specials. They're ending tonight. So take a look. It's it's a great, it'll be a great time. You'll see what the whole plan looks like as well. And I'll turn it back over to the AI guys.
What Mike, we can be a guy sometime, right? But we're still human. So just to let you know, on the hackathon side of it, we took a different position in terms of designing it. It's what the question that we ask: what does it feel like if someone comes into our team and puts them in our shoes and runs the whole course from finding out, or just from the thought is I want to buy an asset, from that all the way down to I have sent a PSA out. What does it look like? And that's why we call it a hackathon. Is by the time you get out, you would know what does it look like to put your name on a LOI and send that email. You will know what does it feel like to call a broker and say, you know what, not making an offer. So that role play comes in. It's not you to university. It's about get your pen and paper, laptop out. It's like immersion. If you have to be in the B school, first 15 days that we can push you through, it's one of them. We like that framework. That's also because we have seen it is different to underwrite thousands of deals versus sending out one LOI. Because once you send out, put your name on it, and you want to wait for the moment that, oh damn, right, the broker gave me a call and now it's my time to play. That feeling is unreal unless you do it. And then getting rejected, that's another feeling that you don't know unless you do it, right? It has an emotional part to it that you have to manage as you get into the deal. And also deal size matters, right? Once you say you are going to cut a $10 million, $20 million check as a lead sponsor, you have to go deliver the project because you have 10 other limited partners betting on you to do that, and that has a different weight to it. And so our goal is that they will take you through the whole process and see what does it feel like, and we'll make some fun to it. And that's why we call it hackathon, right? So anyways, enough about that one. Going back to the AI. Yes, we do AI for revenue modeling. So we have from our large assets, we have a revenue management software that we brought in. It looks at the current price, the demand, and it's automatically does some regression and a bunch of other stuff. Look at the competition, our vacancy rate, then it's asked to solve something. So that's one place we use AI. Second thing, we use chatbot quite a bit. So when a tenant comes in, fills out the form, the chatbot triggers in. The chatbot has enough database. We cannot build the data set enough. The bot knows what to ask, what not to ask. Then the goal of the bot is, number one, get back to the applicant as soon as they fill out the form. And the second thing, push the conversation point where they can go to the website and schedule an appointment. So the bot does the appointment settings as well. So that's one. So those were where we're seeing the most, and we are getting performance out of it. On the back end, on our internal to massive side, we're playing with some of the other stuff, especially on the finance side. It's not quite working. We're breaking things, but it's a lot more coming in. So AI will be a version of wherever we go. And then for the underwriting, I think the platform that we use, they're bringing in AI a little bit. So it's giving us a flavor of that, hey, if I underwrite the asset in this part of Dallas, what are the good asset, strong performing asset, not so strong performing assets, OpEx would look like. So we kind of benchmark by saying that, hey, we're not too crazy or we're not betting too much. So we can kind of calibrate that. So AI is coming into life quite heavily, and we expect that to go a lot further in as we kind of progress. The interesting part about AI is, please do not trust those Instagram videos where you can do something in 2 minutes. It doesn't work. It sounds cool. By the time you want something you want, or you get something you want, it takes a lot of time. And with the AI, the biggest specialty is your own database. Do you have enough data to teach the bot to do whatever that you're looking for? So we are figuring things out. But yeah, we use AI heavily, especially on the chatbot side of it, and also the revenue modeling side of it. Back to you.
And we've used it a little bit on the marketing. You just have to humanize what it says. So it can give you the volume of content. Then you need to personalize it and say it in your own words, because it's kind of interesting. But we actually have a lot of fun sometimes with what it starts out with.
It is fun. I mean, you gotta have it. Sometimes we play with it. So we have Massive always likes to test, right? Unless you test it, you don't know. So we do limited testing. And Trevor was right. For one time we started it and it was going somewhere we didn't know, so we kind of shut it down. But it's fun.
Awesome.